people say, I want to be full-time in real estate. Okay, that's great. But it's still a job. If the money was free, everybody would be in real estate. Of course, it seems like that it was that way for a while. Everybody was going to real estate. Okay, joking a little bit, it's pulled back a little bit. We have fewer players on the field. A lot of people got washed out. So the idea here is you just have to realize you are going to get paid on the back end. So consign yourself or resign yourself to 3, 4, 5, or if the market turns against you, maybe 6 or 7 years of work before you see that giant payday.
Hello, everyone, and welcome to the Journey to Multifamily Millions. I'm your host, founder and CEO of Zana Investments, Tim Little. And on today's show, we have with us George Roberts. George is the founder at Roberts Capital Enterprise and host of his own podcast, The Foundery. George, welcome to the show for the second time. You joined us way back on episode 31. So welcome back, my friend.
Love it. And thank you so much, Tim. It's great to be back. I love your show.
Yeah. And so I know you're a very busy guy. You have a podcast, your investing business, and now a book. But before we get into all that stuff, please tell us how you got started on your real estate journey and how you got to where you are today.
Absolutely. I started as an accidental landlord. That was in the depths of the Great Recession. I had the opportunity to keep my family home, which wasn't worth much, to tell the truth, at the time. And at the same time, get a great new cash flowing asset while I moved up and bought a new family home. So that opportunity was really my introduction to landlording. And I realized that I loved it. I loved the cash flow. I loved working with people. I loved being able to provide an essential service. And years down the road, I realized that not only did I want to be in real estate, but I wanted to do it at scale. And I thought, hey, I've got a great job, 6 figures, enjoy what I do. But if I do this on the side, I'm not going to buy them 1s or 2s at a time. No, I want to go for 10, 20, 50 units. And I think that was a very pivotal decision. I decided that I'd go into multifamily and I never looked back.
Yeah, and talk to me about the reasons for multifamily specifically, because there is the aspect of scale, right? Like things get easier and cheaper with scale, but what are the other unique aspects of multifamily that differ from, say, just the buying multiple single families?
One thing is the tenants. You're going to have a different tenant base, and a lot of times it's a little rougher. You're definitely dealing with a different group of people. Something I like, the psychological aspect of it. If you're, I think, a good person, you provide a good product to people. They really appreciate that because not everybody is good at the business of landlording. Mm-hmm. The second is the ease of implementing property management. Now, when I say landlording, I think a lot of multifamily people probably turn it off. Yeah, I hope we didn't lose you because you don't really have to be the landlord in the sense of dealing with everybody's problems. But at the same time, I think you get the very best end of being a landlord because you get to set the policies and somebody else deals with the person who can't pay the rent, but obviously had plenty of money for pot this month. Let somebody else deal with the crazy psychological issues that people often have. And at the same time, you can set the policies, say, hey, we're going to keep this place in repair. We want to attract the finest tenant base. You get to make those business decisions and you get to benefit when your apartment has a nicer tenant base than the apartment down the street.
Yeah. And the thing that I noticed that is interesting to me, like you might come into this type of business saying, oh, if you have a professional property manager, right? Say you have a 100-unit property and you have a full-time property manager, full-time leasing agent there. They would be the expert in every aspect of running a property. And to a very small extent, that's true. They are very capable at running the day-to-day, but just like any business, they run into problems, right?
Yeah.
And I'm always surprised at how, like, when we come together as a group on these property management meetings with the different owners, trying to help solve the problems of the property manager, because ultimately it's their problem too. You know, you come up with some really creative ideas just because these people are coming from different backgrounds. And so they're able to provide all these recommendations that maybe the property manager hasn't thought of, not because they're not good at their job, but just because us as owners are seeing it from a higher level perspective and maybe have faced those problems on previous properties ourselves.
Yeah, 100%. And I think one of the things that you're driving at here is the difference between property management and asset management. A lot of people, as you said, they think, hey, I got this property manager. I'm done. Passive income. Not exactly. You have to set the policies. You have to decide what is the budget for renovation, for example, and how many units do you renovate? How do you renovate them? Do you take the best to worst, or do you start focusing on the ones that just need a new countertop? There's all these things that you can do. And it's really your business plan. At the highest level, I think that asset management is really the most exciting thing. You set the policies, you set everything in motion. And when you hire the right team, it all comes together.
Yeah, and there's the creativity aspect too, right? When it comes to, say, like additional sources of income. The property management team may not be thinking about that so much as they are about making sure that they're leased fully and tenants paying. And so we're able to step back and say, what are some other ways that we could be making money by perhaps providing a service that tenants would want anyways? Some simple examples are like trash valet, for example, or paid parking spots. Maybe if parking's tough and someone's willing to pay an extra $25 or $50 a month to have that reserved parking spot, they want that. That provides you additional income. But that's something that maybe the property management might be hesitant to do because they don't want to raise rates or fees any higher than they have to, because that might make their job a little bit harder. So there's this balance that comes into play.
Yeah, a very delicate balance. And I like the way you put that, because consider if you're making a percentage on the rents, if the rent goes down $100 and you can get that thing leased this week, you don't care about your percentage of that $100 a month. You want it leased today. Whereas obviously that means a lot more to us as the owners. And so we always have to be doing these rent surveys. You do that all the time. And here I think is another thing. When you're supervising your property managers and when you're coming up with your business plan, you mentioned a lot of great things. Valet trash, your own assigned parking space. These are beautiful. Like I had a place where it's not possible for everybody to park in front if everybody parks straight. But if you angle the parking spot, you can. And little things like that allow you to run the place better. You got to think from the perspective of a tenant. I've got one place where we installed security cameras, and that alone, and just cleaning things up, made a huge difference. We sent a message that there's a new sheriff in town. So it doesn't always need to be something like adding an amenity. Just having a clean and safe place to live is an amenity in many places. And if you don't mind, I'd like to add one quick thing here, because I see a lot of underwriting. And there are a lot of people who think they could take a C- place and they're going to add valet trash and assigned parking. And maybe they got parking garages, or we're going to put a carport in there, and we're going to have a swimming pool, and that they're going to raise the rent $500. And I just want to warn people, that's not going to happen. All of these are good ideas, but if you're not in a good area and you don't have a property that's nice already, or the willingness to improve it vastly, your tenants that are just getting by paycheck to paycheck, they don't want all of those things. Find out what they want.
Yeah, that's hugely important. Like you said, doing tenant surveys is one way to find that out. If you're going into like you said, a Class C- property, the problem is a lot of times those are surrounded by other C- or D properties. Every once in a while, you may find that random diamond in the rough that's a C property in a B neighborhood. And that's where you really have the opportunity to raise it up to what the surrounding area is. But it's really hard to fight demographics, i.e. what the surrounding area is. So yeah, I recommend against putting in that pickleball court in that C- property before doing the tenant survey to find out if that's really on the top of their list.
Yeah, exactly.
Yeah, that's awesome. So talk to me about how your business developed. You said you got into multifamily, and then I assume, did you start passively investing first, or did you start on the active side and then go into passive investing? Because I know you've done both.
So it was about the same time. And I would say that if you do have cash, and a lot of us, you might be in your 30s or 40s, you might have a 401k, makes it a whole lot easier. Definitely become a passive investor first, or at least concurrently with becoming an active investor. But some of us are hard-headed like me, Tim, and we just got to go and do it ourselves no matter what. So I did do both, and both taught me a lot. And what I would say is that people who don't invest passively, who say, I'm an operator, all my capital goes into my properties, and hey, hats off to you, bless you, if that's how you are. But I learned something about every passive investment that I make, And because I'm able to have my fingers in multiple pots and I'm able to invest more widely. Now, as an operator, I stay in my lane. I'm in multifamily, and I know specifically what sort of multifamily I'm looking for. I like Class C. Okay. I like to reposition assets. I like smaller properties. I like tertiary markets.
Hmm.
There are all these niches that I found that you're not going to hear that from the guru, because the guru can very easily sponsor your 100 or 200 unit deals. I didn't go the guru route. So I had to fight my way up, scrap my way to the top, starting with these smaller properties. And I have properties that are over 100 units as well. But I want to send the message to people that you don't have to do that. My first property, multifamily, was bought with real estate investors who had been in the business for over a decade, but who had never purchased a multifamily property. We bought something, there were rats in the kitchen. We had pest infestations when we took it over, but we got a sweet deal. And we only had to put in, I think, about $90,000 a piece. And when you look at that, a lot of these single family landlords, they don't leverage. So what do you get for $90,000? You can hardly get a single unit. But we got 14, the three of us banding together. And there was some deal fatigue. The seller had two deals that fell through during COVID, but we decided that it was a good enough deal that we were going to pull the trigger. And part of the reason it was such a good deal is that when you're on that third deal and two of them fell through, you are willing to accept that lowball offer. Somebody else trained that seller, and it wasn't the broker. The market trained that seller that you need to drop the price if you want to sell this thing this year. And we were able to move right in. So if you're willing to start a little bit smaller, you can skip a lot of the rigmarole and 14 units. That's a whole heck of a lot more than a duplex or a tri or a quad.
Yeah, and I think it's a good point, because a lot of us do go from duplex to 100 unit, and you can do it, but then there's the difference between, I assume that wasn't a syndication, right? For that 14
No, it
unit.
wasn't. It was a joint venture. And that's another thing that I would recommend, because people say syndication is great and it's wonderful. If you have the ability, but you don't have a whole lot of money, you can become a syndicator and you can grow your wealth reasonably rapidly, at least on paper. Those of us who have done it know that you get in that first deal and you give away a lot of it probably to a larger partner, and you get an asset management fee. And you realize, even if it's say like a 50 unit or something, you don't get paid a whole lot of money to take care of that asset. You get paid on the back end. And there's a good reason for that too. You're going to get an acquisition fee. And unless you go for a real giant deal the first time, 100, 200 units, you're probably not going to get much of an acquisition fee. So just understand that you're going to be, it's a job, right? People say, I want to be full-time in real estate. Okay, that's great. But it's still a job. If the money was free, everybody would be in real estate. Of course, it seems like that it was that way for a while. Everybody was going to real estate. Okay, joking a little bit. It's pulled back a little bit. We have fewer players on the field. A lot of people got washed out. So the idea here is you just have to realize you are going to get paid on the back end. So consign yourself or resign yourself to 3, 4, 5, or if the market turns against you, maybe 6 or 7 years of work before you see that giant payday.
Yeah, and I think this is such an important point to foot stomp, because I hear so many, you use the word gurus out there, who say something to the effect of, I'll make you financially free after your first deal. And I'm like, no, 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 no. No, you won't. It is virtually impossible to become financially free from doing one deal for all the reasons you just mentioned, right? You may get that acquisition fee up front, but unless you're heavy hitting in terms of the amount of capital that you're able to bring in and negotiate, then it'll be nice, it'll be something. But in terms of the big payoff, that's going to be, like you said, at the end. So you're waiting, again, like you said, 3, 4, 5 years. And I don't want to say it's like an unpaid job, but it's a matter of creating this pipeline of deals, knowing that payoff is down the road. But in that meantime, you don't expect a whole lot of income. And I think that's what a lot of new folks are unprepared for. They say they quit their job or whatever, and then they're like, I'm just going to do this full time. You're not getting a check every week anymore.
Right.
And that's a rude awakening, I think, for a lot of folks.
It is, because, you have to look a little bit behind the headlines. That's why it's good to have a significant amount of money in your own deals,
Yeah.
because your money, generally speaking, is pari passu with the passive investors. So the check that you get every month is pretty much the check that the passive investors get. So it's not just about aligning your interests with them and looking out for them. You're also looking out for yourself. You put a large amount of money into your own deals. That's one of the ways that you can feel like you're getting paid over those years.
Yeah, and that's a good segue into something that I wanted to cover, which is the purely limited partner passive investing side of things. And I joke with people that my end goal is to just be a passive investor. Like
Oh,
that,
for me, it's not a joke.
yeah, and I guess you're right.
However,
It's not a joke. That is the end goal, to just be passive investing and have those sweet distributions come in every month and have it be enough to where I can hang out on a beach, read a book, whatever the case may be, somewhere down the line. But help us put into context for folks who maybe just got started passively investing. Realistically, what can they expect, and how much do you really have to invest in terms of getting enough to, I don't know, fund your retirement or your lifestyle?
I wouldn't say, I'll give you two answers. First is the standard answer is, what's your lifestyle? Look, I've got two
Right.
kids.
It
All right.
depends.
One of them, I hope he gets a scholarship, but he may be going Ivy League. My expenses are not your expenses, or not the guy down the street's expenses. So you got to look at that. And you also have to see how lean you want to live. How much do you really need? And this is one of the things I talk about in my book, is that I observed one day while I was riding out in the park with my son. I'm at a park. It's free. We're about to go to Urban Air. We pay $19 a month for that. He can go as often as he wants. He gets a free slice of pizza. Like, the best things in life are free or cheap. And if you look at it from that perspective, maybe you don't need as much money as you think you do.
Mhm.
But then I want to say that the flip side of that is don't think of it as that you have this freedom number. Like, when I have this much money, then I will retire. I will be completely passive, and I'm just going to do what I want all day. Because at that point, you tell me that you're not going to travel, that you're not going to have hobbies. Your desires, human desire, I will tell you, as a matter of philosophy, is limitless. So whatever you think you want to retire on, you could easily spend 5 or 10 times as much as that. So it's all just a matter of how hard of a lifestyle do you have to have. At the same time, realize that number is going to grow.
Yep. No, I think that's fair. And so it really comes down to, like you said, determining, what your lifestyle is, potentially how much that costs. And after that, it's really just a math problem, right? If you look at the
Yeah, for sure.
averages of what kind of return you can expect on your common passive investment, and just break down the numbers that way. But again, just like the people who are doing it actively, becoming financially free after the first deal, I don't think you should expect that either as a passive investor, right?
Yeah, and if I can give you another perspective, Tim, like I talk about this in the book, the freedom quotient. So don't ask how much money do I need to retire, because it'll change, but ask how much of my time do I spend doing the things that I love. So I wake up in the morning and I've got someone that works for me that I can supervise. I find that very rewarding. Writing books is rewarding. My kids come home. I get to have lunch with them, right? Late lunch, 3 o'clock. And I spend almost my entire day doing things that I want. It's not that I'm not working anymore, but I'm passive enough that when I'm working on my active work, or even when I'm investing in stocks or I'm investing passively in someone else's deal, that I'm doing what I want almost all of the time. And that should really be the goal, is how soon can you get to be doing what you want? And if you're still working for somebody else some of the time, or you still have to run these deals because you're not a passive investor yet, just always make sure that every day you're getting closer to that ideal of, I do this thing called what I want.
Yeah, and I consider that the time freedom piece, right?
Yes, I'm freedom.
Yep. You have control over your own schedule. You do what you want when you want. I think that's absolutely true. All right, so let's move on from there. It looks like there's some shifts in the commercial real estate market, and I'll say multifamily specifically. And since that's what you're exclusively focused on for your syndication side, I would really like to get your thoughts here. I've seen not every market, because every market is different, but a lot of markets that were especially hot before have somewhat softened, maybe rents softening a bit, occupancy softening a bit in some of these areas. What are you seeing with your properties, and is that causing you to make any shifts in your business plan?
Yeah, absolutely huge shifts. My first property, large property, was in Orlando, Florida. I'm not
Okay.
buying out there right now. I would look, but it's unlikely that anybody's going to sell to me at a price that I think is productive.
Right.
So when you look at markets that are, as you said, hot or that not so hot anymore, it's always the hottest markets that do that. Tampa, Florida, Orlando, a lot of markets in Texas. The hotter it is, the more likely it is to cool off suddenly. So you could look at home prices by state and by market. Go someplace like fred.stlouisfed.org. Take a look at how volatile these markets and ask yourself, am I investing in the first inning? Is this a seventh inning stretch? Or is this the bottom of the ninth? And we don't have very far to go before things may reverse. The other thing that I would say to people is you really have to look at supply. For the longest time, we really didn't have supply coming online. So all you had to look at was the demand side. Are people moving to the area? The demographics are good. Let's invest there. But now you really have to look at the areas that are overbuilt. So when I invested in Orlando, we had tremendous tailwinds. And then for the last couple of years, we've had some significant headwinds.
Mhm.
But a lot of that building in many places has started to peter out. If you take a look at the statistics every month and it's Census Bureau HUD, they will show you the residential construction. And what we've seen is that we really haven't been building above 1.5 million. That's the replacement rate. That's what we need to do for a growing country and to replace the real estate that's become obsolescent. And we really haven't gotten a lot far ahead of that, except for maybe a little bit of last year. Now, all our leading indicators, our starts and our permits are telling us that we're not going to get above 1.5 million for a long time. So on the one hand, the supply side, it is calming down a little bit, but more importantly, the multifamily supply is decreasing. Now, I'm talking to you right now about national statistics. I don't know if you invest in Cincinnati, Ohio, or whether you're in Nashville, Tennessee. But looking at those national statistics, you can see that the multifamily starts have gone down quite a bit. And as that washes through over the next couple of years, we're going to see that there's going to be a whole lot less multifamily coming online. So not only are we going to have less real estate in general, because we're all competing for a place to live on one level, but more importantly, our more direct competition in multifamily is coming down. So I would say, look, if you got property now and you can hold on for 2 years until the end of 2027, that's probably when we're going to see significantly lower rates as well as significantly less supply. We're going to see that rent growth, the kind of rent growth that creates the optimism that caused multifamily prices to shoot through the roof in the first place.
Yeah, you raised a lot of important points there. I love that you talked about not just the multifamily starts, but the housing starts as well, because they feed into each other, right? There's a relationship there. And yeah, I don't think housing starts are going to increase anytime soon, just based on the consistent rate of inflation, cost, and it just doesn't, it's not beneficial for housing builders to build, say, entry-level housing, right? So anything that is being built is at a much higher demographic, but at the same time, you still have 7% mortgage rates, which is stifling the housing sales. And that's not going to improve anytime, which will at least maintain the need for apartments for the time being. And I think what we saw happen was 2024 and then early 25 maybe was like peak for multifamily completion, somewhere around there, at least in certain markets like Dallas, Houston. Those places saw their multifamily completion when these things that got kicked off in 22, 23 and took a couple of years to build. Now there's thousands more units available. That's causing some of the strain and the holding down of rents and prices. But once that wears off, like you said, within the next year or two, and there is no more units coming online, then eventually we'll get maybe not back to where we were, but going in the right direction anyways.
Yeah, 100%. If I can correct, I think I said the end of 27. If you can get even to the end of, say, 26, get close to 27, I think you're going to see that we're going to have significantly better prices. And of course, that's going to bring in the next boom of building. But so it is. If I could just add one more thing, you did talk about competition, and you underscored the point that it really is one housing market. All of those units are going to be occupied by somebody, and we all impact each other. Jay Parsons from formerly of RealPage had some great visualizations of data where he shows that these markets that are getting a lot of Class A, the rents for Class B and Class C are under pressure. The old guru, that is telling you that, hey, buy Class C, it's okay, because guess what? The Class A's, they get kicked out. They're going to come to Class B. It's going to come to Class C. That's not really what happened. It's certainly not what happened during the pandemic. And we can see even in the recent data, just from more supply on the Class A side, that wherever the building happens, it's going to put a pressure on rents wherever you're at. So yes, look most closely at your closest competition, but realize that all housing is competition.
Yeah, and I feel when you're talking about A, B, and C, like part of the issue was the gap was starting to close between those levels, and we hadn't really seen that as much before. But yeah, when it's not much of a leap to go from like one to the other, then that's when you're going to start either losing or gaining between those different classes.
Yeah, 100%.
All right. So with that being said, how is your business changing, if it is at all, in terms of your business, your investment thesis, right? You said you're a Class C guy. Are you holding to that? And are the markets that you're investing in now the same as they were, say, a year ago?
Yeah. For the record, Tim, I'd like to think of myself as a Class A guy who invests in Class C. But
yeah, sorry.
No, I'm kidding. Thanks for setting it up, by the way. That was perfect. But as I mentioned, I am changing my market. So getting away from these rent-constrained places. I like parts of Tennessee, like West Tennessee. For the longest time, it has been the runt of the pack. West Tennessee, growing like crazy. You got property in Memphis right now. You're doing just fine. East Tennessee. And notice I'm avoiding Nashville.
Yep.
Center of the state's kind of crazy. Kentucky, I love this. And if you're in these places that I just mentioned, rent is nowhere near constrained. People are spending 13, 15, 17% of their paycheck on housing. If you consider that you can go up to 30%, there's a lot of room to grow. And as people are moving to the more affordable areas, it makes sense. We can't all live in San Francisco. A lot of these people that are in these very expensive areas, particularly younger people, they may not even have a family yet. They've got fewer roots they've thrown down. It makes sense that they're going out there. We have people who can work remotely now. And why not work in the Smoky Mountains? It's a beautiful place to go. West Virginia is providing a huge tax incentive for people to come out there and work remotely. There are huge demographic shifts that have been driven partly during COVID and partly due to the interest rate hikes as well. So I think you want to take advantage of that. Don't go for the hot markets. Go for the affordable markets. Those are the hot markets. And go and take a look at the Midwest. I know a couple of years ago when I was talking about the Midwest, places like Cincinnati, a place that I never invested in but wanted to, you could see the demographics of that have been turning around for maybe 10 to 15 years at least. But only in the last couple of years, people now see that as one of the hotter places to invest. Kansas City is projected to have tremendous rent increases next year. So when you look at these places that, weren't sexy 3 or 5 years ago, a lot of those are the places to invest right now. And being in the Midwest may not make you a ton of money. The Sun Belt might have made you 3 to 5 years ago, but you can park your money someplace where you're getting a good rate of return and you don't lose. You're going to be in the pole position when the best buying opportunities come about, which for all we know, Tim, could be right now. We are on the cusp of seeing significantly lower interest rates. And as we mentioned, the supply is significantly declining, or it's poised to significantly decline. We have all our factors pointing to that now is the time that people are still largely frightened, but things are getting better. As Warren Buffett put it, if you wait for the first swallow of spring, it's too late. So don't wait until you see the swallows. As soon as you feel the thaw, hit it.
Yeah, and I think there's a certain amount of education for investors that needs to happen because like any industry, right, they get used to what everybody has told them is hot. This is where you need to be investing. And so when that changes a bit, then you have to give them all the reasons why, and you just mentioned most of them, of why they might want to consider these other areas. I think an example for me is South Dakota, Rapid City, to be specific. Not a place I would have ever thought I would be part of a deal, but here I am. And to your point, the level of stability that I've had in that deal compared to my other deals that are in the Sun Belt, it's like night and day. It's consistently like 99% occupancy, continuing to raise rents, maybe not at the speed that we projected, but still continuing to raise rents. And it's just going swimmingly. Exactly where we want to see it going since we've closed on the deal. And that's about as good as it gets. We can't expect these home runs of COVID because that was a black swan event. And there should be no expectation of some of the gains that we got during that time. But the next best thing is the stability of promised returns actually coming to pass. Like you said, it's in those markets that we may not have thought twice about, say, two or 3 years ago.
Yeah, and I would say study is the new sexy. And when you look at these returns that people have produced in the past, hey, track record is huge. But you also have to ask about the vintage of those deals. So when you do see the extraordinary track record, but it was with tremendous tailwinds, you got to take that with a grain of salt. And I think a lot of the more, I would say, the more honest, the more reliable syndicators, they're going to tell you, look, I'm not going to give you the same return that I gave you from that 2020, 21, 2022 deal, but I know what I'm doing. I can do this. I'm going to give you a great return. So yeah, we can't expect to replicate that again. So when you see those returns coming from the more recent vintages of deals, for those of us who have exits from more recent deals, that really means a whole lot more.
Yeah, I totally agree. Like you said, the track record matters, but you also have to look at the track record, not just having one. I can claim that I had a deal that went full cycle in 2 years that was meant to go for 5. But if you look what years it went 2 years in, that's exactly why, right?
Yeah, I think I had one in 2021 that he was just under 1 year, and they produced most of what they expected in 5. So yeah, you can't do that twice, or you shouldn't expect to do it twice.
Exactly. These have been some great insights, but right now we do need to switch to the turbo round. So
all right,
I'm going to ask you 3 questions that I ask every guest that's on the show, and I just ask for a quick, honest answer. And I know you know what's coming, but we're gonna go ahead and do it anyways.
I do my homework, Tim. I hope I know what's coming.
Right, we'll and you've done this before, so I don't know. Maybe the answers will change. Some things change with time. All right. Question number 1. What is one red flag every investor should look out for?
Bad comps. Your broker's always going to give you bad comps. Always pull your own. Don't just average a few similar buildings in the area. Find the close comps, and you're going to have to do your own research for that. And also look at the rent roll. Make sure that if you think you got below market rents, make sure that you are seeing above market occupancy. And hopefully you're going to see a large percentage of people that have been there 3, 5, 7 years or more. Those are the sorts of things that really do have below market rent.
Yeah, and I would just say that when it comes to the comps, sometimes you just get into the tough situation where there's not a whole lot of good comps. And I guess I would quickly ask you, what do you do in that situation?
Well, that's a lot harder, and you may have to buy that at a discount. I have a very large network. I talk to people who know the area. And so if you've got somebody who can really get in there and say, yes, I believe we can get these rents, and not your property manager, I love them, but they have a different perspective, as you mentioned earlier. They have a different perspective than us. So don't just listen to the property manager who says, oh, we can raise rents $200.
Yeah, no, that's good advice. All right, next question. What is a myth about this business you would like to set straight?
That you have to go big or go home. By being in multifamily, you're already going big, and I've carved out a larger portion of smaller deals and done very well for myself.
Yeah, that's fair. It's not. A lot of people get into the hype, and that's where you get into the go big or go home mentality. But there's just as much money to be made by even starting off small, like we talked about earlier, and then working your way up. Because I think an important point that we didn't get into before was hey, your percentage of that joint venture that you do, with 3 other people, that's 30% of the property, if we're doing simple math, that you own, 33, I guess, compared to whatever the single digit percentage maybe that you have in equity of a syndication that you're doing.
Yeah, 100%.
All right, final question. What does success look like to you?
I said it before, Tim, and I'll say it again. It's doing this thing called what I want. When you're doing that, when your freedom quotient gets up towards 100%, that is when you are successful. It's when you're able to build your body, your relationships, and your career 100% because you don't have anything holding you back. You're the captain of your own ship. That's where you want to be, in the catbird seat.
There you go. Time, freedom, and control, just like we talked about earlier. All right. Well, George, I want to thank you. This has been awesome. Please tell our listeners if there's anything else that you'd like to share with them.
Yeah, sure. If you want to reach out to me, you can find me at my website, robertscapitalenterprises.com. If you are new to the business and you want to meet other people, to network, I've got a networking call every Wednesday at noon Eastern. I call it CRE Network at Noon, where deals are made. And I also try to be friendly. And so I am still at this point reaching out or allowing people to reach out to me. So if you got deals, feel free to show them to me. And by all means, if you have the opportunity, check out my book, Passionate Living Through Passive Investing. It's still, I believe, just $2.99 as the Kindle edition. If you don't find like $10,000 of value in that book that you bought for $2.99, feel free to send me hate mail.
All right, that's fair. Well, George, thanks again. We'll have all that information in the show notes. I certainly appreciate you coming on again and look forward to continuing to see you do big things on your journey to multifamily millions.
It was my pleasure. Thank you so much for having me back.